Welcome to another edition of the Real Estate Talk Show. My name is Simon Giannini, and today's topic is using your RSP to invest in real estate, which I know many of you have been asking about, and we want to give you the answer. So joining me today is Tony Popley with Fortress Real Capital. Tony is the VP Sales and Marketing and really knows his stuff. Tony, welcome to the show.
Well, thank you for having us on.
Tony, I know you get this question all the time, and at the risk of asking you the same questions that you get probably every single week, we're going to dive into this and talk about, what is a strategy for people to use their RSP. And of course, first of all, the question that I usually get is, who is Fortress? What do you guys do, and why are you on the call? So you want to tell us a little bit about Fortress Real Capital?
Yeah, absolutely. Well, I guess the first thing to talk about is we've been around since 2002, so we're not new at this. Mm-hmm. Typically, the projects we invest in are large-scale projects, many of which you'd see around the city here and all throughout Ontario, some out in Calgary and Regina. We plan to do a lot more out west. But Ontario is just it's still a great market, so we're really focused in and around the Ontario region. Last year, we'd completed about $1.3 billion of projects. And the great thing about the syndicate mortgage concept is it's actually available to the retail consumer. And in Ontario, we're really limited in terms of what we can invest in using your RSP money. Typically, you'd have to go and be an accredited investor, which is, it can actually become quite an obstacle because you're limited in terms of what you can do. Like typically, it would be.
Do you want to explain that a bit? Yeah.
Yeah, it would be like, most people would be investing in, mutual funds, let's say, within their RSPs. And why? Because either they don't know any better, and it's really not meant to be patronizing to anybody. It's just we're really limited. But with something like a syndicate mortgage, you do not have to be an accredited investor. In other words, you do not have to be earning $200,000 a year, or your household earning $300,000, or you have $1 million net worth without your house. I mean, that's what an accredited investor is. For this, you don't have to be accredited. In other words, you'll have people out there that are earning $50,000, $60,000, $70,000 a year for the last so many years. They have a husband and wife, and they do not qualify under the accredited rules.
The average person with the average income can invest, and what would you say is sort of the minimum investment and maybe even the average investment that we're talking about for this kind of?
The minimum investment we usually require is $25,000.
Okay.
It is eligible for your RSP, your RIF, your LIF, your LIRA, even TFSAs and RESPs in some instances. So that can really help you. Our average investor comes in with over $100,000. So, but you can start off small and test the waters, or you can go right in. So it just depends on your temperament.
And just so our listeners can truly understand, we're not talking about liquidating your RSP. We're talking about keeping it in your RSP in a self-directed and investing it through your RSP. So you simply contact, if your RSP is, for example, is self-directed at TD Bank, you call TD Bank and say, hey, I'm selling my Apple stock. I don't know, maybe that's a bad example, but I'm selling my my stock or my fund that hasn't been performing, and I want to shift that investment into this investment through Fortress, and then they handle all the details and paperwork. Correct?
Yeah, it's along that lines. Really, the good thing about it is, let's say you have an account sitting at Sun Life or TD Bank or wherever. It doesn't have to be a self-directed account. We convert it into a self-directed account at Olympia Trust. So our office does all that paperwork. You don't have to worry about all that.
Okay.
You had sort of touched on this where people think, well, I have to withdraw my RSPs, pay taxes, and then open up another self-directed. You don't have to do any of that.
Okay.
It moves over tax-free, and you're off into the syndicate mortgage.
Okay. So let's talk a little bit about a syndicate mortgage, because not everyone is familiar with the term.
Yeah, it's the syndicate mortgage. All it is it's just when several investors would get involved in one mortgage instrument. It's really a fancy term, but it's a pretty simple concept. So
okay.
the good thing about it is, like you would see in your mutual funds or seg funds, you would see that you would have units or shares that can, and they'll change in value. And unfortunately, for most of us, anyways, for the last 5-7 years, that change has been downwards. not going upwards. And in our case, it's a little different. So whatever you put in, that amount, that full face value is actually registered at the local provincial land registry wherever the project is domiciled. So if it's a project is in Ontario or Toronto that you're investing in, you would actually go on title as a lien charge at the provincial land registry. The good thing about that is that's public record, so you can actually go and see your name on there for whatever amount you put in, and that'll be relative to the mortgage amount. So, to give you an example, you could be, let's say somebody puts in $50,000 into a project we have called Progress. Well, they'll see that at the land registry that this person put in $50,000, and it represents 1.45% interest in that mortgage. Mm-hmm. So they're actually on title. So it gives you some principal security where, again, a lot of other investments that are out there, you just don't have any sort of security. You hope everything goes up, and if it doesn't, good luck.
Absolutely, and I threw up on the screen just for people to see a copy of a sample land registry document, and I think I don't know about our listeners, but I'd be a lot more comfortable knowing I've got a land registry document showing my name is secured on real estate as compared to my mutual fund statement, which I get, and every month it's like, okay, what are we going to see this month? Is it red? Do I bet on red? Do I bet on black? Are we going to see an increase or a decrease? And this is a lot more secure, and I think this is what people want to find out about. So let's talk about sort of the process. Now, obviously, we're talking about commercial or residential mixed-use developments, but let's walk people through on how a syndicate mortgage works. So we start off with the developer. They've put down, let's say in this example, $4 million, and they've acquired the real estate, and the bank provides a mortgage for the construction costs. That's what we call the hard costs. And that's where we step in.
That's right. And, again, I mean, I'm sure many people out there have wondered, how do these tall buildings go up? And is it just guys with deep pockets? Well, no, they use sophisticated structures, one of which is a syndicate mortgage. And in this case, so for this example, like you had mentioned, Simon, on a $10 million parcel of land, I mean, the developer is key for us because essentially what will happen is you're actually loaning the money to the developer. So you want to make sure the developer is sound, has got a lot of history, a lot of experience. So they're going to go out, they're going to identify the land. They're going to do their studies. They're going to make sure that, zonings are in place, that the density is good, the absorption studies are good. Once all that's done, you're right, they're going to put some money down. In this case, we used an example on a $10 million parcel, $4 million down. They get a $6 million first mortgage from the bank. And you're right, that's a hard cost. The definition is a hard cost because the bank can only loan you money on hard costs. But the thing is, now with that land, they need to do something with that land. So they're going to maybe put up a sales center, which many of us have visited, right? We'll go to these sales centers and check out the property.
Which are expensive.
Sure. And now then they might want to put up some model suites so you can actually see what the suite would look like. And all those type of costs. There's going to be continual architectural changes being done to the site. So all those costs are deemed to be soft costs, and the bank will not loan you money for that. So
in a sense, it's almost like we're becoming a partner with the developer in essence, and not partner in terms of equity, but partner in terms of they've got the project ready to go. They've got their hard costs. Now they've got their marketing and operations budget they need help with, and all the soft costs, legal, accounting, et cetera, et cetera, et cetera. That's where we come in, and it's registered on title, and it's RSP eligible. And I guess if I'm an investor and I'm looking at a particular project on a case-by-case basis, you're going to show me, what the appraisal value of the project is, and what the financing is in place, and timelines, and so on. So let's talk about an actual offering, and up on the screen now we have Progress Manors.
Okay, so Progress Manors is a fantastic project. It's out on just north of the 401, right off of Markham Road. So it's at basically Markham and Shepherd. It's actually right at Progress and Shepherd, but that's the major intersection. The great thing, how everyone talks about location. Well, there's about 100,000 people coming into the GTA every year, and this is consistent over the last 8-9 years. Mm-hmm. Of the 100,000 people, 60 to 65% of them are now moving outside of the core. And the reason being because within the core, they're building a lot of condos in the core. It's booming down there. And what's happening is they're building 500, 600 square foot condos where as families that are coming in are in need of bigger space. And for that matter, cheaper pricing. So they're moving a little bit on the outside. So all the suburbs, Barrie, Burlington, anything north of 401 is still doing quite well. Why? The price points are lower. And so 65% of the 100,000 people are moving in. And the great
bread and butter housing.
You got it. You got it. That's exactly what it is. Very affordable. Still looks great. And in this case, Dino Scavelli of Pace Development will be one of our co-developers in this deal. The other one being Empire. But just to let you know a little bit about what Pace does, I mean, they've been doing this for 30 years. They've done over 3,500 units already. They've won numerous awards, Building Excellence Awards in the town of Markham, 3 times in the last 10 years, I believe. The Terrion Award of Excellence. So they're a reputable developer. And what will happen is, again, in terms of the concept, when you actually get involved in a project like Progress, you would be loaning money to these developers. So you want to make sure these developers are credible. And that's why it's really important to us, before we would vet a project and go ahead and take on a project with somebody, we would go through perhaps over 100 projects a month. We would look at them. We could spend $30,000 or $40,000 on a project not to do it. So we really do our homework. So when you see term sheets and what you're about to see on screen, there's a lot of homework that's been done on this prior to you seeing it.
So you're researching location. Obviously, this is the great location for the Progress development, and this is the development summary that we're talking about. So we're talking about reviewing, understanding location and zoning and risk, and making sure that it's a mature development, and on and on. So you guys are doing your due diligence now. When we talk about the numbers now, let's get to the numbers, because I get that a lot. Okay, so give me the nitty-gritty, Simon. So here's an investment summary, and this is sort of a typical investment summary for a syndicated mortgage. So I'll let you walk us through this, Tony.
Okay, so yeah, it is. This would be a very typical, I guess is the right word. I mean, 3 years is, sometimes we'll have a 2-year deal, sometimes we'll have 4 years, but typically it is a 3-year. And in the case of Progress Manors, let's just say somebody was to move $100,000 from an RSP, or again, a risk Mira, or cash for that matter. And that $100,000 goes into the project. Again, you would have a charge on the project. So you actually have some form of principal being secured. In return for that, you would be a 3-year project. Year 1, you'd get 8%. That would be paid out to you quarterly. So that would be paid right in. If you were in your RSP, it would be paid right into your RSP. Right into your RSP. So again, tax deferred. Yeah. If you did it as cash, it would come to you as a direct deposit into your account. Year 2 and 3 would be similar. So every quarter you'd be getting 2% basically. And then, so at the end of 3 years, you have $24,000 in interest that you've accumulated. The $100,000 is then returned back to your account, or from wherever it came from. So for the cash, it comes back as cash. And then you would get to participate, as we call it. It's called a deferred lender fee, but essentially what it is profit participation. So there's a bonus. That's right. It's bonus, and that bonus is indexed. So the 8% is actually fixed. And the reason why we are allowed to use the term fixed is because that money is actually put aside in trust with a lawyer. The Fortress never actually handles any of that money. So the 8% is put aside. That's why we're allowed to use the term fixed. The 12% that we use on the back end for profit participation is not fixed. That will vary depending on the actual numbers of the project. So to give you a quick example, let's just say on Progress Manors, and this we share with each client, and they'll be, we're going to go through it in detail with you. Let's say we're going to show a $20 million profit in our performance. Now, if we hit that $20 million target, you get 12% of whatever it is you put in. So in this example, you get $12,000. But let's say we didn't hit 20 million. We were short, and we hit 18 million. So we were 10% short of our target. Well, then your 12% would fall by 10%. So that means
11.2 or 10.8.
10.8.
10.8, yeah.
And likewise, if it goes the other way, if we're 10% better, you would also get that 10% better.
But again, that's estimated bonus on the back end.
Correct.
But even
again,
aside from that, we're talking 24% that's in trust with a lawyer, and your original investment of $100K or whatever that amount is secured on title. So it's about as safe as it gets. It brings up another question. As you were talking, I know you're saying you could do this in your RSP, RESP, TIF, all of that, but you could also do cash. Now here's a question, and I think I know the answer, but I'm going to ask you. Let's say I've got $100,000 equity in my house, and I have $100,000 unused contribution limit in my RSP. Can I borrow $100 from my house, put it in the RSP, get a $100,000 tax break, and put it into this vehicle?
We do it every day.
So now we're talking about something very, very creative, because if I know that I can borrow on my home equity at about, let's say, 3.5%, 4%, and I'm making 8% minimum, I'm doubling my investment. I'm making 4% on money that I don't even have, and I'm getting a tax break on $100,000. I think people really understood this, Tony. I think the question is, are you going to do this, or are you nuts? Because it actually becomes really, really easy.
It really is. I'm really, really excited about it. It's, I personally have an office out in Calgary too, and this has brought me back into Ontario. The project here is so exciting, and it's so accessible to everybody. And what you just mentioned is such a powerful tool if you really understand it. So, definitely get in touch with, yourself and get a hold of us. And if you're interested to really learn more about it. One last thing, Simon, I would like to add about this is, when a client says, I want to get involved for whatever amount of money, whenever they do get involved, we go through, of course, all our due diligence. They're going to be handled by a mortgage agent, a licensed mortgage agent. Mm-hmm. And then what will happen is we actually perform an ILA. So what that means... Do
you want to explain what an ILA is?
It's independent legal advice.
Mm-hmm.
So what will happen is the client will walk them through everything. They're going to sign off a lot of paperwork to this, of course, because you're registered everywhere. Mm-hmm. All these docs go to different regulatory bodies here in Ontario. But what will happen is the lawyer will get on and explain risk and reward, and explain to you, do you know that you're in progress manners, and the address is this, and the loan to value ratio of the project is this, and your interest will start on this date, it will finish on this date, it'll be this amount, it'll be very, very clearly outlined.
It's and all handled by a lawyer, it's all secured in trust and on title, so it's about as secure as you can get. Now, I know you got to run, but I want to cover one last thing with you, Tony. So, and just so people realize that Progress Manners is one project that we're talking about here, but that we're also depending on when you contact Fortress, there could be different developments available. So what I'm showing up on the screen is a lot of the previous offerings, a lot of developments in the core that I see: King Charlotte by Lamb, King City by Pace, all of these different projects all over the city and all over the country, so that depending on when you call, there would be different offerings. And of course, once Progress Manners is sold out, then there could be another deal. So when you contact Fortress, Tony or somebody from his staff will explain which developments are available. And you also alluded to the fact that you have to deal with a mortgage broker. I'm not qualified to sell this stuff, so I don't try. I pass my clients along to people like Fortress. So for those of you that are interested in just getting more information, because that's really the next step, what we'll do is call our help desk, 416-366-9090, or fire us an email, info@reccanada.com, and we'll connect you with Tony and his staff. They'll get you all of the information, and sometimes you like the idea, but you may be too late for a particular offering, or you need to maybe wait for the next one, that kind of thing. But they'll walk you through, answer all your questions, and that's it for today. So, Tony, thank you so much for being on the call. Very informative, and a lot of good stuff for people to think about.
Thank you for having me.
So again, just call our help desk, fire us an email. We'll get you in touch with Tony and the experienced people at Fortress, and hopefully we can get you some very fantastic returns in RSP. And that's it for today's show. Thank you again for joining us on the Real Estate Talk Show, and we'll see you next time.